You know what keeps me up at night? It's not the charts. It's not the technical levels. It's watching people who know something's wrong, who feel it in their gut, who see the warning signs everywhere they look. And they're still waiting. Waiting for the perfect moment. Waiting for one more dip. Waiting for absolute certainty before they act. And I get it. I really do. Because making a move on gold feels like a big decision. It feels like something you should think about, research more, maybe wait until after the holidays, or after you talk to your financial advisor, or after the market settles down a bit. But here's what I need you to understand, and I mean really understand. The window is closing faster than most people realize. Let me show you what's happening right now, in real time, that most investors are completely missing. 3 weeks ago, the People's Bank of China made an announcement that barely made headlines in Western media. They added another 23 tons of gold to their reserves. Now, you might think, okay, that's interesting, but what's the big deal? Here's the big deal. That's the 18th consecutive month of purchases. 18 months. And here's what makes it absolutely critical. They're not slowing down. They're accelerating. But China's not alone. The Central Bank of Poland just announced they're targeting 20% of their reserves in gold. 20%. They're currently at 14%. Do the math on what that means they need to buy. Turkey added 30 tons last quarter. India's been quietly accumulating. Singapore, traditionally conservative, has been building positions. Even the Czech National Bank, which hadn't touched gold in decades, is now actively buying. This isn't random. This is coordinated de-dollarization happening in real time, and it's moving faster than the mainstream financial media is reporting. Now I want you to think about something. When central banks buy gold, they're not doing it for a quick trade. They're not looking at the 50-day moving average or trying to time a pullback. They're making strategic decisions about the next 20, 30, 50 years. They have access to information we don't. They have economists, analysts, intelligence briefings about global monetary policy that you and I will never see. And they're buying gold like their currency's future depends on it. Because it does. But here's where it gets really interesting. And this is the part that should make you sit up and pay attention. The COMEX, which is the major exchange where gold futures trade in the United States, is showing something I've never seen in 15 years of watching these markets. The ratio of paper gold to physical gold has blown out to levels that are frankly absurd. We're talking about 250 ounces of paper claims for every single ounce of physical gold in the vaults. Think about that. If even 1% of those paper holders decided they wanted actual delivery, the entire system would seize up. And you know what's crazy? It's starting to happen. Delivery requests are spiking. In October, we saw delivery demands that were 340% higher than the same period last year. The people who understand how this system works are getting out of paper and into physical. They're not waiting. They're acting now. Let me tell you a story that perfectly illustrates what's happening. In 2008, right before the financial crisis really hit, there was a hedge fund manager named John Paulson. Most people hadn't heard of him. He wasn't on CNBC every day. But he saw something in the mortgage market that other people were missing. He saw the cracks forming. And while everyone else was saying, housing always goes up, and this time is different, he was quietly building the biggest short position on subprime mortgages in history. People thought he was crazy. His investors were getting nervous. The trade was going against him for months. But he understood something fundamental. When the math doesn't work, when the system is built on leverage and assumptions that can't hold, it doesn't matter how long it takes. Eventually, reality catches up. And when it did, he made $4 billion in a single year. Now, I'm not saying we're in exactly the same situation, but I am saying this. The math on our current monetary system doesn't work. The debt levels don't work. The deficit spending doesn't work. The idea that we can print unlimited currency without consequences doesn't work. And just like 2008, there are people who see it clearly, who are positioning now, before the crowd figures it out. The difference is, in 2008, the solution was to print money and bail out the banks. It worked, kind of, because the dollar was still trusted globally. But what happens when the next crisis hits, and the solution is to print even more money? But this time, the world doesn't trust the dollar the way it used to. What happens when central banks around the world have already started moving away from dollar reserves? What happens when the BRICS nations have built alternative payment systems that bypass the dollar entirely?
That's not a hypothetical future scenario. That's happening right now.
The BRICS nations just announced they're developing a gold-backed trade settlement system. Let that sink in. The largest emerging economies in the world are creating a way to trade with each other that doesn't use dollars and is backed by gold. When that system goes live, and it's coming faster than most people think, the demand for dollars drops and the demand for gold explodes. And here's the thing about supply and demand in the gold market. Supply is essentially fixed. Gold mining production has been flat for years. In fact, many of the major gold mining companies are reporting declining production. The easy gold has been found. The big deposits have been mined. Yes, there's still gold in the ground, but it's deeper, harder to extract, more expensive to produce. Meanwhile, demand is going parabolic.
You've got central banks buying at record levels.
You've got wealthy individuals in Asia and the Middle East accumulating. You've got institutional investors who are finally waking up to the fact that maybe, just maybe, having zero gold exposure in a world of unlimited money printing isn't the smartest strategy. And you've got regular people who are watching their grocery bills double, their rent increase, their savings lose purchasing power every single month. And they're starting to ask, what actually holds value?
Now, let me address something important.
Because if you're sitting on retirement accounts, if you've got a 401k or an IRA with $100,000 or more, you need to understand something that most financial advisors won't tell you. You can hold physical gold in a retirement account. It's called a gold IRA, and it's completely legal, completely legitimate, and it lets you get actual physical precious metals into a tax-advantaged account without taking a distribution or paying penalties. I put together a free guide on exactly how this works. It's in the description below. It covers the process, the rules, the companies that specialize in this. If you're in that situation, it's worth 5 minutes to understand your options. Because here's the reality. Your retirement account is probably 100% in paper assets right now. Stocks, bonds, mutual funds, all denominated in dollars, all subject to the same monetary risks we're talking about. Anyway, back to why timing matters more than you think.
There's a concept in markets called phase transition.
It's when something that's been moving gradually suddenly moves violently. Water sits at 99 degrees and it's just hot water. But at 100 degrees, it boils. That 1 degree makes all the difference. And gold is approaching that phase transition point right now. Look at what happened in 2011. Gold had been in a bull market for years, moving from $250 an ounce in 2001 to $1,900 by 2011. But here's what most people forget. The biggest moves happened in the final 18 months. From January 2010 to September 2011, gold went from $1,100 to $1,900. That's a 72% gain in less than 2 years. And during that run, there were multiple periods where it moved $100 in a single week. The people who made life-changing money weren't the ones who bought at $1,800, trying to catch the last bit of the move. They were the ones who bought at $800, at $1,000, at $1,200, when everyone else was saying, "It's too high, I'll wait for a pullback." The pullbacks never came. Or when they did, they were brief and shallow, and by the time people decided to buy, the price was higher than where they originally hesitated. And here's what's different about right now compared to 2011. The fundamentals are exponentially more bullish. In 2011, the US debt was $14 trillion. Today it's $36 trillion. In 2011, the Fed's balance sheet was $2.8 trillion. Today it's over $7 trillion. In 2011, central banks were still net sellers of gold. Today they're the biggest buyers. In 2011, the dollar's reserve currency status wasn't being actively challenged. Today, it absolutely is. Every single fundamental driver that pushed gold to $1,900 in 2011 is not only still present, it's dramatically worse. And yet, gold is only at $2,650. Does that make sense to you? Because it shouldn't. Let me tell you what I think is really happening. I think the market is mispricing the risk. I think investors have been conditioned over the last 40 years to believe that the system is stable, that central banks have everything under control, that the dollar will always be the reserve currency, that inflation is transitory, that debt doesn't matter. And that conditioning is so deep that even when the evidence is screaming otherwise, people can't quite bring themselves to act.
It's like the frog in boiling water analogy. You know this one. If you drop a frog in boiling water, it jumps out immediately. But if you put it in cool water and slowly heat it up, the frog doesn't notice the gradual change until it's too late. That's where we are. The water's been heating up for years. Your dollar buys less. Your savings earn nothing. Your cost of living keeps rising. But it's been gradual enough that most people have adjusted, adapted, accepted it as normal. But here's the thing. The temperature is spiking now. And the frogs are starting to notice. I'm seeing it in the data. Physical gold demand from retail buyers in the U.S. is up 35% year over year. Coin sales from the U.S. Mint are at levels we haven't seen since 2020. Premiums on physical gold over spot price are widening, which means supply is getting tight. When you go to buy physical gold right now, you're paying $80 to $100 over spot for a 1-ounce coin. A year ago, that premium was $40. That's the market telling you something. There's more demand than supply at current prices, and this is before the general public catches on. This is before your neighbor is talking about gold at the barbecue. This is before CNBC is running "Gold hits new all-time high" as their lead story every day. This is before the FOMO kicks in. You know what happened in 1979 and 1980? Gold went from $200 an ounce to $850 in less than 2 years. But the really crazy part was the final 6 months. From September 1979 to January 1980, gold more than doubled. It went from $350 to $850 in 4 months. And during that period, you couldn't find physical gold. Dealers were sold out. Premiums were 30%, 40% over spot. People were lining up outside coin shops. It was absolute mania. Now, I'm not predicting that exact scenario plays out again, but I am saying this. When gold moves, it moves fast. When the psychology shifts from, "I should probably own some gold," to, "I need to own gold right now," the price doesn't wait for you to get comfortable with the decision. And here's what concerns me about the current setup. We're in this weird period where the smart money is accumulating aggressively, but the general public is still largely unaware or unconvinced. That gap doesn't last forever. At some point, something happens. Maybe it's a currency crisis in a major economy. Maybe it's a sovereign debt default. Maybe it's a geopolitical event that shakes confidence in the dollar. Maybe it's just the slow realization that inflation isn't going away, and cash is a guaranteed loser. Whatever the catalyst is, when it hits, when that phase transition happens, the people who waited are going to be paying dramatically higher prices. And I don't mean 10% or 20% higher. I mean potentially double or triple what you could buy it for today. Think about this. If you're 55 years old right now, planning to retire at 65, you've got a decade. In that decade, what do you think is more likely? That the U.S. government gets its fiscal house in order, reduces the debt, stops deficit spending, and restores confidence in the dollar? Or that they continue on the current path, printing more money, running bigger deficits, and slowly eroding the purchasing power of every dollar you've saved? I think you know the answer. And if you know the answer, then the question isn't whether you should own gold. The question is how much and how soon. Now, let me address the common objections, because I know what you're thinking. Gold doesn't pay dividends. You're right, it doesn't. But your savings account paying 0.5% while inflation runs at 6% is paying you a negative real return. Gold preserves purchasing power. That's its job. Gold is volatile. Compared to what? The stock market that can drop 30% in a month, the bond market that just had its worst year in history, the dollar that's lost 98% of its purchasing power since 1913. Gold is volatile in price, but it's stable in value. There's a difference. What if I buy and the price drops? Here's the thing. If you're buying gold as a long-term store of value, as insurance against monetary chaos, as a hedge against the debasement of fiat currency, then short-term price fluctuations don't matter. What matters is that you own a real asset that has maintained its value for 5,000 years.
What matters is that when the dust settles from whatever economic turbulence is coming, you'll still have wealth. But here's what I really want you to understand. The risk isn't buying gold and watching it drop 10%. The risk is not buying gold and watching everything else lose 50% of its purchasing power, while gold goes to $5,000 an ounce. That's the real risk. The risk of inaction. I talk to people all the time who tell me they wish they'd bought gold at $1,200 or $1,500 or $1,800. They saw it going up, they knew they should buy, but they waited. They wanted to see if it would pull back. They wanted to do more research. They wanted to wait until they felt more certain. And now it's at $2,650, and they're still waiting. Still hoping for that pullback to $2,000 that might never come. Don't be that person. Don't be the person who understands what's happening, sees the warning signs, knows what they should do, and still doesn't act because the timing doesn't feel perfect. The timing is never perfect. The perfect time to buy gold was 20 years ago. The second best time is right now. And here's something else to consider. Even if gold does pull back in the short term, even if it drops to $2,500 or $2,400, do you really think that matters in the context of where it's going over the next 5 years? If gold is going to $5,000 or $10,000, which I believe it is based on the fundamentals, then buying at $2,650 versus $2,400 is noise. It's a rounding error. What matters is that you own it before the real move happens. Look at the institutional money. Look at what the big players are doing. Ray Dalio, one of the most successful hedge fund managers in history, has been vocal about owning gold. Paul Tudor Jones, another legendary investor, has said he's long gold. Stanley Druckenmiller has talked about the importance of hard assets in this environment. These are people who have access to the best research, the best analysts, the best information in the world. And they're buying gold. Are they timing it perfectly? Probably not. Do they care? No. Because they understand that when you're making a strategic allocation to an asset class based on fundamental drivers that are going to play out over years, not weeks, the exact entry point is far less important than simply being positioned. And that's what I'm trying to get across to you. This isn't about trading. This isn't about trying to catch the exact bottom or sell the exact top. This is about recognizing that we're in a monetary environment that is unprecedented in human history, where every major currency is being debased simultaneously, where debt levels are unsustainable, where central banks are trapped between inflation and recession, where the global reserve currency is being actively challenged for the first time in 80 years. In that environment, owning gold isn't speculation. It's common sense. It's financial survival. It's the rational response to an irrational monetary system. So when I say you don't have time, this is what I mean. The window where you can buy gold at reasonable prices, with reasonable premiums, without competing with panicked buyers, without supply shortages, without having to explain to yourself why you waited. That window is closing. Not in years, not in months. It's closing now. The central banks know it. The smart money knows it. The question is, do you know it? And more importantly, are you going to act on it? Because here's the brutal truth. A year from now, you're going to look back at today's price and you're going to have one of two reactions. Either you're going to think, thank God I bought when I did. Or you're going to think, I can't believe I didn't buy when it was only $2,650. Which one of those do you want to be? The choice is yours. But the clock is ticking. And unlike the stock market, where you can always buy more shares, or real estate, where you can always find another property, physical gold has real supply constraints. When it's gone, it's gone. When the premiums spike, they spike. When the price runs, it runs. Don't think you have time, because you don't. The move is happening now. The question is whether you're going to be part of it, or watch it from the sidelines, wishing you'd acted when you had the chance.